Today was decision day for the European Bailout Fund, of which a German constitutional court ruled in favour, paving the way for the European Stability Mechanism to be used to help tackle the region's debt crisis. Despite the certain conditions laid out by the judges, the decision sparked a relief rally in the forex market. Joining me now to discuss current market sentiment and some currency pairs going forward is Nils Rosendahl, an analyst at Nordea Markets in Stockholm. Thank you for joining me, Nils. Now, first of all, today's ruling by the German Constitutional Court seems to be largely what had been expected. But talk me through market sentiment so far today.
Yes, it's been in line with expectations. The German court approved it, and they also put some strings attached to the approval. However, this is quite of a positive decision for the European Union and for the common currency as well. And we will unlikely have a big default by a major country such as Spain and Italy within the next 1.5 years or so. So now, as the ESM is approved, this means that it's a 500 billion package, of which 100 billion is spent so far. That means that there are more than 400 billion left. And then assuming that the ECB would now match with buying in the secondary market with about the same amount, the buying power is about 400 billion in total. And that would cover the total borrowing need for both Italy and Spain until the mid of next year. So it's a positive sentiment, and it should be. But talking about the euro-dollar in specific, the big thing here would, of course, be the Federal Reserve coming up tomorrow night. And, of course, a disappointment with no QE from the Fed could, of course, put down the euro-dollar cross again and weigh on the entire sentiment.
Well, speaking about the euro-dollar in a bit more detail, a majority of market participants are pricing in more QE from the Federal Reserve tomorrow. What is the most likely outcome you see taking place tomorrow in terms of the Fed, and therefore the euro-dollar going forward in the short, mid and long term?
Yeah, we think it's a very difficult call tomorrow. We assume that the market is actually pricing in about 600 billions of QE, outright QE. We don't think that's a very tasteful alternative. We don't think it's very likely, actually. But, of course, if Ben Bernanke doesn't deliver tomorrow, he could maybe hold up anticipation for this to come later on this year. And that would maybe make the whole disappointment not really to come tomorrow. And hence we are actually tactically quite flat to the euro-dollar. We used to have a short position in it, but we have taken it off for not so long ago. But on the longer horizon, we still see a broad dollar strength. We don't think this big QE program will actually be launched this time, and we don't see a major further dollar appreciation going forward. So in a year from now, we see the euro-dollar to be trading around 120.
Now moving on to the Australian dollar, in some analyst opinions, the Australian dollar possesses the characteristics of both safe haven and high beta currencies. Although the currency is obviously sensitive to commodity price movements and China's economic prospects. What base case scenario have you built your Australian dollar US dollar forecast on when looking forward on the 12-month horizon?
As for the Aussie dollar, we still see a fading strength in the Australian dollar, and that's much due to the fact that the Chinese economy is probably not in as a good shape as we have assumed it to be. And we don't really see that stimulations from the China nor from the US will be able to help that. So the macro picture is actually quite bad. It's quite hard to see that these days when we are so sugar rushed by this stimuli from both sides of the Atlantics. But the macro is still very, very bad, and we think that will definitely take out its toll on, as you mentioned, commodities, which are very closely linked to the Australian dollar. Hence, we see the Aussie to actually go down way below parity in a year from now, and maybe to go down even as low as to 0.9.
Finally, Riksbank surprised market participants this month by lowering its repo rate this month by 25 basis points, stating that the downside risks are now bigger than the upside risks. Where to now from here for the Swedish economy in terms of monetary policy and the strength of the Swedish krona going forward?
Yeah, it was a bit of a surprise that they actually lowered the rate in last meeting, but it was priced either that they would cut this time or in October, and now we don't anticipate them to do anything in October. But we still see a cut again in December, basically. So we see that also the macro picture here is of course not isolated. We are a very small economy, and we are very, very closely linked to especially the European economy through exports. And that will make the monetary policy to be likely slightly dovish going forward, even in Sweden. And we see a lower repo rate and hence a bit higher US stock, especially now since we take out some tail risk from the euro dollar. or from the euro itself. The Swedish krona has been somewhat under a safe haven pressure over the last half year or so. But as there is no imminent threat to the euro currently, we see that this would also continue to underpin the euro stock.
Thank you very much for your comments, Nils. I'm afraid that's all we actually have time for at the moment, but there are plenty of exclusive interviews and financial updates to keep you updated on DukascopyTV. So do stay tuned. Goodbye for now.